Welcome to our third video focused on the issue of audit. This video will be devoted to fraud and its impact on the audit process. Please have in mind that we're basing this video on our express notes, and therefore it is advisable that you download those notes from the website www.theexpgroup.com. Now, what is the impact of fraud on the auditor? Now, if you can imagine, fraud will have some impact on financial statements, where people steal from the company. That does have an impact. Now, consider someone who takes the money out of the company to his or her pocket, but being an accountant makes the following entry: debit, payable, well, credit, obviously cash. Now, this payable was reduced by the amount that was actually pocketed by the employee. What it means is that in the financial statements, the payables, the liabilities, are understated. In reality, there is a liability. The liability exists, that is not shown on the balance sheet, simply because it was offset with the money that was paid, but to someone totally different, to someone that the company did not owe any money. So something like this leads to understatement of liabilities. Now, as you can imagine, if it's material, then there might be a problem for the auditor, because the auditor ultimately is supposed to detect or material misstatements. So, what do we know about fraud and its impact on the auditor? Well, first of all, there will be two types of fraud. The first one is the one we discussed just a second ago. It's a misappropriation of assets. Clearly, pocketing cash is a misappropriation of assets, and it is fraud. However, after the corporate scandals of the early 2000s, another item was added to the definition of corporate fraud. It's fraudulent financial reporting. And the reason why it was added was that actually it is the same thing as the former. If someone manipulates the accounts, if the accounts are manipulated, in the accounting world it's called cooking the books. So if someone cooks the books, what it leads to is that the reported profit is higher than the real profit. Now, what this leads to is bonuses are being paid to certain employees. Certainly, there will be some bonuses to the managers. The managers, the directors of the company, are responsible for the preparation of financial statements. So by cooking the books, they increase the bonuses. However, those bonuses should never be paid, because the real profit would not justify this amount of bonuses. And therefore, these bonuses are in fact stolen, which leads us back to misappropriation of assets. So remember, there are two types: direct misappropriation of assets. That's something that happens very often where there is lack of segregation of duties. And the second part is fraudulent financial reporting. That part is usually in the hands of the managers. Now, one thing to remember, one critical thing, is that auditors are not responsible for the detection of fraud. First of all, auditors are not policemen, and fraud is theft. And therefore it's a criminal offense and it should be prosecuted by relevant authorities. However, auditors are responsible for the detection of material misstatements. So regardless of the fact that they're not supposed to detect fraud, auditors will still have to detect material misstatements even if they result from fraud. In reality, what it means is that auditors' procedures will include the consideration of the likelihood that fraud is being committed. If the auditors decide that there is a chance fraud takes place in the company, they should perform some further procedures. They should, first of all, determine whether the extent of fraud can lead to material misstatement. If so, there is either a possibility they will do some more procedures, or they might even withdraw from the assignment, because fraud is a very sensitive issue. If they suspect fraud, which is usually difficult to find out, simply because it is usually well concealed by those who commit it, they might say that there are some limitations on the work that they can do. They simply will not be able to perform their work, or it will be very risky that they will not detect something because they know or they suspect fraud is going on. Therefore, to summarize this bit, fraud may have two types. Each of them may lead to material misstatements in the financial statements. Auditors are not responsible for the detection of fraud. However, they remain responsible for the detection of material misstatement, and therefore they need to consider the likelihood of fraud being committed in the company. If they decide it's probable, they have to take further actions, either adjust their procedures to accommodate the risk of fraud, or even withdraw.